we went to this mastermind thing, and this was right after AJ. You were still like had a cane. You just met everyone. You just told your story, and everyone was like, "Oh, AJ, like you're such an inspiration, such a good story." They had us walk through the woods to get to this like event, and so I'm walking with AJ. We're chatting, and AJ bails like hard, and like everyone's like, "Oh my god, are you okay?" And I started laughing, and he started laughing too. And I was like, "Sorry, man, it was pretty funny." Like, you bailed. And I was the only one that laughed, so I'm pretty sure I think that's why AJ's friends with me.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, welcome to episode 79 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband, and I'm here with the three best friends for the new year. It's been a while, guys. It's nice to see you. How you doing, Jay?
Doing great. Happy New Year.
Yeah, Happy New Year.
It's crazy. The minute we start recording, my dogs start going crazy. You can hear them in the background. Sorry about that.
We'll go snuff them out like last time. It worked pretty well. Are you drinking tonight?
I am drinking tonight. I broke out a bottle of Malbec called High Altitude Malbec from Argentina. So again, a gift from somebody. I have no idea where it came from, but I'm hoping it's good.
That's one of the reasons why, by the way, when I give out a bottle of wine as a gift, I actually write a message on the bottle because that's what happens.
There probably was one at some point, and I took it off and I forgot. I'm sure I thanked the person, but thank you again to whomever gave this to me.
There you go. That's great drinking tips from Mauricio right there. Mauricio, what are you drinking?
Dude, I'm back to look, it's the first of the year, so I'm on a little bit of a little kick. So I'm back to the Pisco, but this time I got the Coca-Cola, but it's a Diet Coke because I'm trying to keep the calories down. So New Year's resolutions, you know how that goes, Kyle.
What is your resolution? You got one? Should we go through resolutions or no?
Dude, it's always a health one, man. It's always freaking drop 1,000 pounds and body fat down to whatever. And there it is again.
You know what I did? I went and got one of those cold plunge ice baths. I've been doing that.
Oh my God. What a waste of time.
I don't know. Go look up Huberman. He's a big proponent for it, the neuroscientist.
Supposedly it keeps your inflammation down and helps with muscle recovery after workouts.
There's a lot of things. You talk about testosterone levels and things like that.
It probably helps you, load the dishwasher too.
I love loading the dishwasher. AJ, actually, you kind of look like Huberman a little bit. You could probably pass off as it. Are you? What are you drinking tonight? You back to the red Solo?
Well, like him, I am a health freak, so I just got done with my milkshake. Now I'm drinking Diet Coke out of this red Solo cup.
You should have brought the milkshake. What's your milkshake flavor?
It was Oreo.
Ooh, wow, the fancy kind. Okay, well, I'm going back to. I tried this one in a previous episode, and I kind of liked it, and I kind of forgot about it. It got pushed to the back, but I'm going to go with the Still Austin cask strength bourbon. So there we go. Ready to get in?
Did you see that? Did you see the new whiskey Trump glass?
I did
with
not.
A bullet through it. It's got a bullet through it, but it's just for your whiskey.
Oh my God, that's awesome!
Bulletproof.
Bulletproof Trump 47 whiskey glass. I should get that for you.
AJ, you should have got us those glasses instead of those t-shirts.
If I would have known, I would have got them for you guys.
It's a little bit more practical. I would drink it every night. Until actually, you know what, Jay, instead of these like steins, like these big mugs, like we should just get like normal little glasses that we can all use.
Oh, I don't know, maybe a wine glass here and there. Who knows?
Yeah, exactly.
We'd have to change our logo. We'd have to.
We could etch it in. Like this one's got it like etched in. You could do that. All right. I don't even know what to do. We've been away for so long. I feel like it's like I'm nervous to get into it. But
you even forgot. What time we start.
Oh my God! I showed up at 6:57.
Yeah, 15 minutes late. We're all just twiddling our thumbs waiting for you.
You show up regularly late, Mauricio, and AJ rolls in right on time too. Producer Alex sets everything up for him. He just walks in, puts his milkshake down, and starts talking.
True. Yep, that's exactly correct.
All right, well, let's get right into it because Mauricio and I are super excited to watch this next discussion because we are about to talk about how great Biden was as a president. So, regardless of your political affiliation, no presidency is perfect, and there are going to be some wins and some losses at the end of the day. So, Jay is going to walk through all of the, well, we're going to call it the Biden scorecard, I think is what we're going to call it, of how he performed. And when it comes to things like the economy, housing, inflation, and spoiler alert, inflation was bad. So, Jay, why don't you tell us how Biden did this year or how great he did?
And let's be clear, I did not say that I'm going to be talking about all the great things of this presidency. But that said, things weren't horrendous. But let me start with a few caveats. Number one, a lot of the stuff that we talk about, and you're already laughing at me, a lot of the stuff we're talking about, presidents don't impact these things directly. You can say that they're responsible because they're at the top, but they can't necessarily impact all of these things. A lot of things that they do impact, they're not going to see the impact during their 4 years in office. And so a lot of these things are holdovers from the previous administration or 2 administrations or 5 administrations previous. Some things are out of their control. I mean, we saw that with COVID. You can't blame COVID on Trump. You can't blame like the price of eggs on Biden right now with the bird flu. I mean, I'm sure Mauricio probably would, but some things are just out of control. And the other thing we have to consider is that we have a big asterisk around 2020 and 2021 thanks to COVID. So certainly when we compare like the current administration to the last administration, we can't take into account 2020 for a lot of things because it skewed the data. Even 2021 skewed a lot of the data. So it's going to be a bit more of a nuanced discussion than it otherwise would be when COVID wasn't a factor. And then finally, let me just give kind of a spoiler alert. If you look at a lot of the data I'm about to talk about, not all of it, but a lot of the data I'm about to talk about, the current administration, the previous administration, the Trump administration, and even the Obama administration, the second term Obama administration, were all pretty similar for a lot of this data. And a lot of that's just the result of the fact that from 2013 to now, we've basically been in a bull market. So you're going to see a lot of good data out of every administration when you're in a bull market. So with those caveats out of the way, let's jump in. You mentioned inflation. Inflation is probably the biggest really bad thing that we saw with the current administration. We got up to about 9.1%. We're down now about 3%. But if you look at the 4 years in total, the Biden administration, we saw over 21% inflation in the last 4 years, which is just killer because prices don't go down.
Well, that's not his fault. That's definitely Jay Powell's fault, right?
Well, no, I would argue that it's. I would argue that it's. Well, we'll get into debt next, but I mean, I think most people who know anything about economics agree that a lot of the driver of inflation is how much money you're printing. And if you're printing a lot of money, you're gonna see inflation. And so maybe we go right there. Let's talk about debt for a minute. So in this administration,
well, Jake, you forgot to do for inflation. I see in your notes here that you didn't compare it to Trump, or for some reason you keep bringing up Obama here. You gotta let Obama go, man. Like it's you're one of those traditionalist Democrats who just yearn for Obama to be back.
No, the reason I put Obama here is I think it's a good context because a lot of times you see Trump, you see Biden, you want to compare the two and you have no context. Are these good numbers historically or bad numbers historically? And Obama's administration gives some context when you're comparing like the last 2 administrations of another administration that's basically gone through a bull market, gone through a good part of the economic cycle. And so, so I mentioned Biden inflation about over 21% for the last 4 years. And again, that's probably being generous because we all know that CPI isn't true inflation. It's probably higher than that. Trump, in the 4 years that he was in office, he was at 7.8%. Which is a pretty good number. And then if you want to compare to Obama, his second term, he was at 5.2%. But I mean, we saw in the years leading up to Trump that inflation was actually well below historical averages. So long story short, the numbers are really bad the last 4 years. I don't need to tell anybody that. We all know that inflation has been horrendously bad the past 4 years. But to put numbers behind it, about 21%, and then compared to about 8% under Trump. So let's talk about what leads to inflation. debt is one of those things that when you print money, you're going to have inflation. And in the current administration, in Biden's administration, we've printed about $8.4 trillion. Big number. If you look at the Trump administration, it was actually pretty close. They printed about 8.3 trillion, but a lot of that money that Trump printed was the last year of his term during COVID, as opposed to Biden, where it's pretty evenly spread out between the 4 years. And so if you remove the last year of Trump's term, if you say 2020 isn't really indicative of how much money we were spending, and we do the same thing with the first year of Biden's term, we say, yeah, we're still in COVID during the first year of Biden's term, so let's remove that. So we're comparing the first 3 years of Trump and the last 3 years of Biden. It was still not even close. Trump printed 3.4 trillion during his term, which was a lot, but not so much compared to Biden's 6.1 trillion that he printed in his last 3 years. If you look at it in terms of a percentage of GDP, things are a little bit better for Biden. Trump printed about 17% of GDP on average across his first 3 years. Biden printed about 22% of GDP across his 3 years. Both numbers really high.
How does it look if you take out 20 and 21? Because it's different as a percentage of GDP when the government was the GDP.
Yeah, and so that is taking out 20 and 21. Taking out 20 and 21, Trump was at 17% of GDP, Biden was 22% of GDP. So two big numbers. By comparison, Obama's second term was 16% of GDP. So basically, he and Trump were about the same, and then Biden was a good bit higher. So long story short, all three of those folks, I would argue, have contributed to inflation by their just out of control money printing. But the Biden administration, I mean, we saw this with the Inflation Reduction Act or the Infrastructure Act, whatever you want to call it, and all the other money that's been passed and spent over the last couple of years has just been out of control. And so
I think it's important to recognize too, because you did a good comparison of GDP, right? But one of the big things with inflation that's important to look at is percentage of the money supply. And I think this is where they got it really wrong, was during inflation, as inflation was ramping up, they spent 30%, the government did, in a year of the total M2 money supply. So once inflation started, they increased the money supply by 30% a year.
Yeah, I remember we were talking about that. We were like, hey, did your guys' net worth go up 30%? Because if not, then you're behind now.
Yep, exactly. And that's like gas on a fire with inflation. Obviously, take out 30% of the money supply, because raising interest rates, that's all interest rates do, right? It's to try to shrink the money supply. So you're fighting the Fed raising interest rates while the government is actively, vastly expanding the money supply. You're shooting yourself in the foot.
And I think, and Jay, you typically listen to or read the Fed transcript, but I think Powell alluded to it. And he's alluded to it often, I guess, but in the last one, he specifically kind of emphasized that, hey, at some point, there's only so much we can do. I mean, there's a fiscal part. If the governments keep printing all this stuff and don't get that under control, I think he again reiterated that we are on an unsustainable path. We cannot keep doing what we're doing. At some point, and the big question is when, how far can you kick the can down the road? Because we can all, I think you can kick it down far, but at some point, this thing's going to implode. And the question is, based on our system and our structural way things are set up, are we ever going to get to a point where we can actually change the course, or are we just going to inevitably fall off the cliff whenever that cliff arrives?
Don't worry. Elon Musk is going to fix it, right? So we can move on. Well,
it's interesting, and I think we're going to be talking about this next week, but the debt ceiling, basically, is Congress going to agree on how much money we're allowed to spend this year over and above how much money we're bringing in? So what level deficits is Congress going to allow us to spend this year? And that's going to kind of set the tone probably for the next several years. So it'll be interesting to see if we have ridiculous deficit spending again this year, or if we actually start some austerity measures and rein in spending this year. And I have a feeling we'll have
Republican or Democrat, they're all frickin' politicians that spend money. I have no confidence that the Trump administration is going to dramatically curb spending.
What's the new saying, or it's been now for probably almost a decade now, but it's like, the Democrats they tax and spend, and the Republicans don't tax and spend. Like they're all spending, and there's not like you have the conservatives, and they're all spending up the wazoo.
Okay, so that's inflation. That is our national debt. Both really bad numbers under the last administration, or the current administration, Biden's administration. And hopefully we have inflation under control. We're down about 3% now. Hopefully we can get that down further. And I suspect that to keep it down, we're going to have to curb spending, and hopefully we'll do that over the next couple of years. Let's take a look at something that was actually pretty good on the economic front. So real GDP. And normally when we talk about GDP, we talk about what we call nominal GDP. We don't adjust it for inflation, but I like to adjust it for inflation because we want to know, are we really making more money in this country? Adjusted for inflation, are we not? And if you look at real GDP numbers, over the last 4 years, about $2.5 trillion increase in GDP, which is great. Compared to even Obama and Trump in their administrations, it's a good $1 trillion more, and that's adjusted for inflation.
So we spent $9 trillion and we got $2 trillion increase in GDP.
Agreed, but I mean, you can argue the same thing. In the last administration, they spent $9 trillion and they got $1.3 trillion in GDP.
It's like a 4-year payback, AJ. That's fine.
It's fine. Every single year.
Yeah. And so, I mean, GDP, we want to see GDP growth, and you're not going to see me defend inflation or debt. I mean, we spent a ridiculous amount of money. But like you said, we got something out of it this time. I would argue that even if you look at Trump's administration, that 1.3 trillion was a decent GDP bump in terms of real GDP. So no complaints there. Again, I think if you look at the last couple administrations, the last 2 or 3 administrations, the numbers are all pretty good. Again, with the exception of inflation and debt, which, I mean, those are the big numbers. Those are the ones that crush us.
Do you think we would have gotten GDP growth without it on all of them? I mean, all the last 3 administrations, like without the massive spending, do you think we could have yielded GDP growth?
Not to that level, obviously, but I mean, they grew a lot of other, like the government grew quite a bit too. Like they had government healthcare growth all the way through. When we talk about those job numbers, I always shit on like they kept growing those two sectors.
Yeah, I mean, a lot of the GDP growth that we see in this country is financial sectors and technology. And we've had a good 2 decades in both of those areas. And so will we have seen the same amount of GDP growth? Probably not. But by the same token, I think like any president that had come in when Obama did, or maybe not Obama, but when Trump did or Biden did, likely would have seen some pretty good GDP growth simply because we were in a good part of the cycle. And we saw a lot of companies, a lot of large cap companies that were growing very quickly over the last 10 years. And I mean, I don't know how you could have avoided seeing strong GDP growth for the last 8 years.
Well, just productivity too, right? We've seen pretty big productivity boosts. So, that leads obviously to growing GDP.
That's the good thing going forward. I agree with that. I think we have huge gains in productivity that are unrealized.
100%. And I think over the next several years, I expect that we'll see GDP growth from things like AI and additional automation that are starting to be put in place.
What about when crypto gets to $1 million a coin? Does that affect GDP?
So, I mean, we should have a separate discussion about crypto, but I think crypto going up is going to be really bad for the economy because at the end of the day, our incoming administration is going to have to decide what's more important to them, boosting crypto or boosting the dollar. Because at the end of the day, if you put a lot of effort and money behind boosting Bitcoin, you create a strategic reserve. Basically, what you're going to be doing is encouraging other nations around the world to do the exact same thing. And when other countries start hoarding Bitcoin, they're not going to have nearly as much need for the dollar, and we're going to see a weakening of the dollar. So, separate discussion.
Let's do a separate discussion thing. I did want to point one thing out on the GDP, which it's just something to be aware of, and that is when you're comparing the nominal GDP with the adjusted, there's something called a GDP deflator, which is how they officially adjust for it. And if you're in the camp where you believe that, inflation is generally understated, like, even though the official CPI number is whatever 3%, but let's be real, we really think it's more like 6%, then that's also going to boost up that GDP number that adjusted. So there's an assumption in there, and that GDP deflator is the official government number. And if you take other GDP deflators in there, your adjusted GDP is much lower than the official printed number. Just an FYI.
Yep. Okay, so moving on, let's talk about jobs and employment. This is one of those where you have to ignore 2020 for jobs. I think you also have to ignore 2021. I mean, if you include 2020, Trump's numbers look horrendously bad. Not his fault that COVID happened. If you include 2021, Biden's numbers look way too rosy because you had the recovery. And so you have to ignore that as well. So if you just look at the last three of Trump and the first three of Trump and the last three of Biden, Biden gained about 8.4 million jobs. Trump was about 6.4 million. But again, COVID was a big enough disruptor that 2 million jobs margin of error, I think, is just, it's in any other situation, 2 million jobs is a huge disparity. But I think in this case, it's quite possible that we were seeing the recovery well past 2021, and a lot of those jobs that Biden gained were actually jobs that were lost under Trump. And it's really hard to figure out when we kind of draw that dividing line between like COVID is starting.
Well, your research that you did, which was really good, you even kind of pointed that out, where you took and you look at unemployment levels, everything else, and it's like when all's said and done, if you kind of take that out, they're fairly close. I think Biden's better than Trump's, but it's like nothing staggering. Well,
in these days, once they do the annual report, they claw back about 1 million plus jobs from the jobs gained every year. So you could take 1 million off the top right there.
Absolutely. And so I would say both administrations have great record on jobs. Employment, likewise. Trump was at 3.6% unemployment just before the pandemic, which was a fantastic number. Biden got down to 3.4, but I mean, again, margin of error, it's the exact same thing. And he's now up at 4.2, so it wasn't sustainable.
I think if he would have done worse on the jobs, and that actually, like, if he would have not gotten nearly as many, if we would have had unemployment higher, that would have dramatically affected inflation. And I think that would have been better for him. I think if he came out and he had unemployment significantly higher than Trump, but inflation was down, I think it would have been better.
Absolutely. And I think we all agree that, not all of us, but most of us agree that if you have to choose between inflation and unemployment, you choose unemployment because that's temporary. Inflation, prices never go down.
And marginal. So 2% of the population as opposed to 99%.
Exactly. Really good point.
I don't know. Inflation's not bad for real estate investors. So when you say we're all going to agree, depends on what level inflation we're talking about.
I don't think this inflation's been good for any real estate investors.
Well, the downstream effects afterwards, AJ, if you remember in the run up in inflation, it was excellent for real estate investors. So now we've learned our lesson, though. When we see that run up, then we got to be prepared for the back end side of it. And Jay Powell just sticking on the brakes on us.
Yeah. Last pure economic thing that I'll mention is real wages. And this is another really important one because inflation obviously is bad, but if wages are going up fast enough, that can be mitigated. Unfortunately, we didn't see wages going up that fast in this administration. Nice to say, I'm happy to say that if you just look at the last 3 years, I mean, again, if you get rid of 2020 and 2021, which were anomalies due to COVID, if you just look at the last 3 years under Biden, we do have positive real wages. We've actually seen wages go up compared to inflation. But I mean, not enough. It's about 2.4%. Trump in his first 3 years was at 4.3%, which is a much better number. If you look at the full term, I mean, if you look at real wages across the full term, Biden was actually down. So since January of 2021 through today, real wages are still down about 0.5%. Trump over that 4 years, which if you look at the data, you'll see that actually 2020 helped real wages. We had fewer people working, but those that did were making more money. He was up 6% over his term. So there's a big difference.
Well, too, that's also not even. Like, so we say like, oh, wages went up. They didn't go up for everybody, right? And so I think this is another thing that people forget. They're like, and you see these pundits that are like, I don't understand why people are mad. Wages are up. And you're like, well, hold on. Take 30% of the country that wages aren't up. In fact, they may even be, less. But with inflation, they're decimated. And I think that's one of the problems is some of the numbers they affect evenly, like inflation, but like other numbers, they don't. So certain percentage of the populations, they are getting hammered on that spread.
And it's usually the lower end of the population too, which is the problem. If your wages and your expenses are already even, then if it doesn't go up evenly, you're going to not have enough money to pay your bills. If you are making an extra 20-30% on top of what your expenses are, then it doesn't make as big a difference, right? Because your baseline effect, your wages are going up on a higher number than your expenses are going up. So it's not as big a deal.
And don't forget the expenses. The part that drives me crazy too is that the expenses aren't all proportionate, right? Like people spend the vast majority of their income on things like rent, right? So rent's gone up way more than the 21% number you gave. I just looked it up. It was about 20 on average, national average across everything is 29%. Some places more, some places less. And then there's like the hidden inflation, which, when mortgage rates go up, not because there's, prices are going up, but interest rates are going up. Obviously, so your mortgage payment goes up tremendously. But yeah, like,
and then third right behind those two is eggs. Like when eggs go up, then they really affect the common
groceries. And,
we joke, but it's like when you get down, especially to people that are really struggling, like it really is though. Your eggs, like eggs, flour, like these basic milk, this is stuff that dramatically impacts families. And so like we can't joke about it, but you're right in this idea that inflation is not evenly affecting people. And the ones that are affected the most, it's disproportionately affecting, as in the cost of eggs, the cost of that is a much higher percentage when you look at like rent, as opposed to somebody that owns their home and they have a 3% mortgage that they fixed in when their home was worth $300,000 there. And then as opposed to somebody that's got a 30 or 50 in that time frame, both administrations, not a single one, 50% increase on their rent. That is so like that gap and that chasm is really felt in society right now, where it's like we look at the haves and have nots, so to speak, and it is massive because of inflation.
Yeah, we've talked about this a lot, and I probably should have included this in my disclaimers at the beginning of this segment, that there's probably some segment, 10, 20, even 30, 40% of people out there who are listening to this right now who are like sticking their middle finger up at me and calling me names because I'm saying like there are actually good things that are happening in this administration when they feel like absolutely nothing good is happening. And you have to realize that the data that we're talking about is median national data. And it's not necessarily evenly distributed. And what we're seeing when you have inflation, what you see is that those that have assets disproportionately benefit over those that don't have assets. And so there are a lot of people out there that are listening to me and saying, what the F is this guy talking about? Like none of that can be true because I'm living this day to day and I'm not discounting what people are seeing and feeling because there are a lot of people out there who are suffering. And that's just one of those effects of inflation. And unfortunately, I don't know how that changes short term. Long term, it changes by keeping inflation down and getting real wage growth up. We saw this in the 70s and 80s, and it wasn't until we saw a really prosperous time for some lower wage folks, like a decade after the inflation of the 70s and early 80s. Like it was the early 90s before we really saw that economic expansion that helped everybody. And so it could be another decade before we work through all the issues. And so just because I'm saying that the numbers look pretty good, please don't, if you're listening, don't necessarily assume I mean for everybody in every place.
They got AJ, champion of the people. He'll step in when you step out of line.
It's funny though, because first of all, but Jay's right. It's not all bad. It's not anything else. And I think actually that what killed Biden was that it was that he wasn't wrong. So when his administration was going out and bragging about the economy, bragging about job growth, things like that, they weren't wrong, right? But when you're a president, you're doing that and you have people, that's really insulting. And then two, I think it's like what killed Biden was not that everything was bad. It wasn't at all. But what was good was good for asset holders, like Jason said, or Jay said. Everybody else, it was really bad for. And I think that it was the lack of prioritization. So when you look at, like, for example, their stated goals, what they were going to do, it was obviously COVID was in it, but then they had infrastructure, then it was climate change, foreign policy, they had healthcare, and then they had equity and inclusion. That was their stated focus areas. So when you have a portion of the population that's going, I can't eat, my rent's gone up 40%, and you're telling me that that's not even in the priority list. That's not even in the top 10, right? And in fact, it's all this other stuff. When you talk about like economic stuff, you're talking about infrastructure, which means you're spending more money. And I think it was that killed him. It wasn't that it was all bad or it was good, but really it was that lack of prioritization and addressing what was really happening and at least acknowledging it, right, in a real big way. And I think that really hurt them.
Yeah, and I think there's a big difference between acknowledging it and addressing it. I'm the first to say they did a horrible job of acknowledging it, and the Fed probably waited a little bit too long. But I'm equal opportunity here, so I'll piss off both sides. For Biden haters, I will say that I think it was inevitable that we saw inflation in 2022, 2023. If Trump had been reelected in 2020, he would have seen that same inflation. Maybe he would have pressed the Fed to do something about it faster. I'm not sure he would have, but we would have seen the same inflation. At the same point, or at the same time, I'm going to say that I think we're poised to see inflation over the next 4 years. And when we're doing this show 4 years from now, and we do see that inflation, I'm not going to blame Trump. I mean, maybe there are things he'll do to exacerbate it, and
I will.
Definitely. I'll blame him
if now that Jay's not going to blame Trump when there's inflation.
I will.
Well, let's be clear. I mean, if we can attribute it to tariffs, if we can attribute it to deportations, but if he just goes and I don't suspect he's going to do a lot of either, and assuming he doesn't, I still think we're going to see inflation. And so for the
I think it's government spending. So if Biden wouldn't have spent 30% of the actual money supply, we would not have seen inflation like we did. There's just the math doesn't start mathing. Now, the problem is
the inflation started in early 2022. The bulk of the money he spent was right around. I mean, if you look at the Infrastructure Act, the quote unquote Inflation Reduction Act, that was after inflation.
And those acts, are those really Biden, or is that, the
well, it's government, but he's ahead of it, so he's going to get blamed. I'm not saying it. It's just
he has the ability to veto anything, and so at the end of the day,
overspent. It's like they both did it. This isn't a Trump or Biden thing, but what it is a thing is, once again, the spending. So inflation started. The problem is that once they really knew it, so everybody was denying it the first year, right, and saying it didn't exist. Once everybody even admitted it, they didn't change spending. In fact, the 4 months up to election, they spent, what was it, like over $2 trillion? So not only did they not address it, they ramped up spending. And so all of a sudden they were fighting with the Fed. And it was like, and two, once again, I don't think Trump would have done anything different. This is not about Biden or Trump, because
that's the election playbook, right? Like, you got to spend right up to the election. Otherwise, you don't want a down economy going to an election, or you're cooked.
And the problem is, once you already have inflation, now you're getting hit with two sides. They have to raise interest rates to try to offset inflation. But the government, you're sitting here spending. And so instead of actually making it better, you make it worse for the vast majority of Americans, because now they can't buy things because of interest rates. They can't afford things, and they have inflation to deal with. So I think
and the money they're spending, they had to basically lend out. And so the higher interest rates that are creating is creating a bigger spend that they have to pay on interest payments every year.
And that affects yield deficit. And the yield curves moving into the future. And so I think that government spending year by year, it obviously it's 30% of the money supply. That's an astronomical effect.
All right, so we got to wrap this up too a little bit. We're getting a little long, and I know Jay wants to get to housing, because this is, as Mauricio likes to point out all the time, this is drunk real estate. So we should mix in some housing on this.
Yeah. So let's talk about the things I don't let me talk about the things I don't think the president has much control over. The stock market, Biden did great. Trump did great, both up around 60%. But Obama was up 54% during his. I mean, it's just, we've been in the middle of a bull market, and I don't give any of the three of them credit. It's just been a great market. Housing, I don't give presidents much credit one way or the other, because there's not much they're doing unless they're passing significant regulation or legislation to change home ownership rate. I'm hopeful that Trump actually does that this time around, but we didn't see it last time, and we certainly didn't see it under the Biden administration. Home ownership rate's been flat at 65% over the last 4 years. Trump increased it about a percent or two. And so, but again, I don't give either of them credit. Housing values, up under both presidents, Trump up 27%, Biden up 37%. I don't know if that's a good thing or a bad thing. As real estate investors, it's good, but for average Americans, up more money, values up is not a good thing. So yeah, I mean, both presidents have either been good or bad for housing, depending on your outlook. But again, that's the market. We've had inflation, and when you have inflation and you have a bull market, hard assets are going to go up in value. Stock market's going to go up, housing is going to go up, crypto is going to go up. Let's talk about the other one that presidents don't control, and we can argue about this one, but let's talk about gas prices. Everybody
that's really, they can't control it. Like that's a very global market. That's like,
don't we have the petroleum reserves, the strategic reserve that we just, open up the faucets to cap it? But don't worry, we actually we give it back though, right? We've already replenished it. Is that right, AJ? We waited for lower prices and then we refilled it back up.
Here's the thing, and I think this will make a good episode as well in the next couple of weeks. Maybe we do this in a week or two. But I think one of the interesting things that we're going to see from Trump when he comes into office on day one is he's basically going to flood the market with oil. He's going to open up drilling, and a lot of people say that's going to be fantastic for energy prices and the prices of everything. We can talk about it in more detail, but something to keep in mind: when you flood the market with supply, it doesn't take an economist to know that basically what you're doing, on that, if you look at that supply demand curve, you're driving prices down, and oil companies don't want to be driving prices down. And what we've seen is that there's a lot of open permits for drilling right now that aren't being used because oil companies like the fact that there's not too much supply. The other thing to keep in mind is that the oil we drill in this country mostly gets sent to other countries because other people are willing to pay more for it than Americans are. So I'm not convinced that flooding the market with energy and oil is going to change things the way Trump thinks it will, but I think it's a discussion worth having. But let's talk about gas prices real quick. So basically, when Trump came into office in 2017, gas prices were about $2.35. Just before COVID, it was up to $2.55. So up 20 cents in the 3 years between Trump taking office and COVID. Obviously, when COVID hit, it dropped considerably, down 20 some cents between 2020 and 2021, popped up to over $3 in 2022, and now is down to, it's down somewhere like 60, 70 cents to right around $3. So, I mean, at the end of the day, I don't believe presidents control gas prices, but if you look at the data, I mean, Obama had better gas price contraction than either of the presidents. I mean, he saw gas prices come down like almost $1 between 2013 and 2017. And I don't give Obama credit for that. It's supply and demand. And
I will, for one thing, he didn't stop fracking.
He didn't stop fracking. That's true.
And two, also, so there's a few things that the presidents can do. And I agree they can't control everything. 2008, oil prices plummeted because global demand plummeted. But the largest purchaser of oil in the United States is the government. So they will come in and stabilize prices all the time. They'll come in and say, prices are going down. We have excess oil. The government will walk in and buy it all up to replenish. They'll also open up the reserves when it gets too high to bring down those oil prices. So they are a stabilizing factor because they're the largest purchaser. And they also have a lot to do with permits issued. I mean, we saw what happened when the US government got tough on oil. That was bad in the late 90s and the early 2000s, right? Fracking is actually what brought that down. And now they started to go after fracking, but they all had to stop because they're like, this is political suicide. Because if you stop fracking, oil is going to skyrocket in the United States because that's generating a huge portion of it. But with all of that, it still has to deal with the problem with reserve, or not reserve, but processing. We got to a point where we had all this oil, we couldn't process it. So even though oil prices we were pumping tons of oil, we couldn't get it to market. We actually,
because I read somewhere that it's the refineries, right? Because they're like a 30-year payback. And so like, if you're right now, why would you build a new refinery when you are looking at like the last administration where they're trying to get off oil? Like, I'm not going to go and build a refinery that's, you know, like what that's the cost sunk, you're gone. So like, there's just not enough refineries for those situations where you're pumping out a lot.
And I think that's what they can do. Open up the gates to that, get the private sector to build refineries, to do oil exploration, and then to basically tell those oil companies and everything, we'll stabilize it by buying.
Yeah, it's if you believe we should be consuming more oil, but that's a debate as well.
That's not an option. It doesn't matter. We have to.
Okay. I think we can basically leave it there. I mean, if we look at the wars, we got out of Afghanistan, which was great. But I think the way we did it,
getting out of it was a good idea, but the process that it took, I wouldn't really.
I mean, if you look at all the things that went wrong getting out of Afghanistan, not saying that a lot of things didn't go wrong, but compared to the 20 years we were in there, it was a blip. And so the fact that we're out, I think is really good. Obviously we're facing two other major regional wars that are horrendously bad for the world, which isn't good. And so hopefully we get out of those soon. If you look at crime numbers, basically we're back to where we were in 2019. We saw a big spike in 2020. We saw a big spike in 2021, 2022, and numbers are basically coming back down, especially violent crime numbers. We're not quite back to where we were in 2019, but we're still at relatively historic lows. And then if you look at the price of eggs are through the roof, and that's all I know Mauricio cares about. And so
I was at Sprouts last week, and they were out of chicken now. Like, I couldn't get any chicken. Like, they're like, yeah, there's like a nationwide issue of chicken.
Well, I sent you an article the other day, I think, Mauricio, that basically Southern California, thanks to bird flu, is essentially out of eggs and running out of chicken. So expect the price of eggs to go much higher before it comes down again.
Yeah, my wife got some duck eggs the other day.
Yeah, we go through like 5 dozen eggs a week, and so we keep
right
Costco
now.
in business.
I pulled this up because I thought this was interesting. According to a Gallup poll, 69% of Americans say that the pulling out failed, but right now only 54% of Americans say it was a good idea today. So I think how we exited had a huge effect on how Americans perceive it.
Because it depends what you consider a win. Because like we pulled out, like because we're no longer technically fighting in Afghanistan, but we're still like fighting Iranian proxies. Like it's not like the fighting has stopped. It's just we like shifted.
Had we stayed, how many more people and how much more money would it have cost us between then and now compared to?
I'm just telling you what Americans think. So, I mean, if we say we pull out right now, the vast majority of Americans say not only did it fail, but before we pulled out, it was something like 80+% of Americans said, this is a good idea. We need to get out. Today, only 54% say it was. That's
yeah. Well,
and of those people who were polled, like one person knows anything about what's going on.
100%. That doesn't tend to matter, though.
How about this? Reinstitute the draft and then see what Americans think about us being at war.
We don't need to draft. We'll just fund them.
We're going to need less and less actual troops the more AI is taking over. But
we can bomb them from our couch.
Okay. I'm done. Long story short, I think obviously the important stuff has been horrendously bad this past administration, whether you blame it on the administration or you blame it on kind of all the recent administrations, that's up to you. But we've had some bad stuff with inflation. We've had some bad stuff with debt. But overall, I mean, those who say this was the greatest administration ever are obviously out of their minds. Those who say it was the worst administration in history, I think equally out of their minds. It's been an administration that's been driven by the market for the most part, and a lot of people still suffering. But overall, there are a lot of people who have who've done well and benefited, and they're skewing the numbers upwards.
Or you can blame Canada. Actually, that was pretty civil. I was a little worried when we saw the topic that would Mauricio and I were just going to have to sit back here and put out fires. But well done, gentlemen. I feel like that was
There's not a lot to disagree on.
Mauricio, you want to talk about something?
We talk about the Corporate Transparency Act, right?
Well, I think we discussed talking about that, and it was like, I don't know, week by week it changes. So like, I feel like we can't bring it up. Like it's
I think Jay,
it's back, it's gone, it's back.
Let's talk about the CTA. And Jay's like, I think people are freaking just burnt out on that nonsense. And so
I mean, think about it. Like this episode's not going to drop for 36 hours. That data could be that information could be totally scaled by then.
Yes.
CTA in America is like a toxic relationship. They break up and get back together. I
do want to just like a public service announcement, a 15-second thing where they actually came out with the scheduling and oral arguments aren't until March 25th. So the final decision there is not going to happen probably till May or June or sometime in the early summer. So we've got, I think we're good for the next 6 months. And honestly, I don't think it's going to come back. That's my personal. That was one of my predictions, and my prediction's looking pretty good.
There's nothing stopping for the incoming administration. When I say the incoming administration, I mean Trump basically directing the Department of Justice, who runs FinCEN, to tell FinCEN basically, hey, drop this.
Segue the SEC, because the SEC does have a little control over FinCEN there, and President Trump, during his campaign, promised to fire Gary Gensler on day one of taking office. And while Gensler did not give him the chance, he stepped down, resigning effective January 20th, which goes with when Trump is taking office. So Gensler was known as one of the most active chairs in recent history. He had more than 2,700 enforcement actions and 47 proposed rulemakings, which is a lot. Now Trump has already announced his new nominee, which is Paul Atkins. He was previously an SEC commissioner from 2002 to 2008 under the Bush presidency. And this nomination stands a little bit in contrast to Trump's other cabinet picks, many of whom people will accuse him of picking loyalists with very few qualifications. Actually seems like Paul Atkins is pretty well qualified. I don't think anyone can really argue that he's not qualified for the job. So the question is, Mauricio, what changes should we expect to see with this new SEC chair?
A lot. This is really, really exciting. Really for two categories, primarily two categories of people. One, if you're into that crypto nonsense, you're going to love this guy. And if you're a syndicator, capital raiser, you're going to love this guy as well, especially when it comes to accredited investor stuff and having more people access to these deals. And we'll get to that in a second. But by the way, it's not uncommon for SEC or any commissioners to resign. In fact, I think today or yesterday, the CFTC commissioner announced that he was also going to be stepping down January 20th. The incoming president doesn't really have the power to remove them, and they can elect a different commissioner from the 5 that's already there. But it's pretty much tradition. Like whoever's the incoming guy or the outgoing person, they usually resign, and that's what's happened. And yeah, Paul Atkins actually is a really well-respected person. He's a former lawyer, of course. Lawyers, hey, yay. But he's very, very respected in the industry. Unlike a lot of the other nominees that have been controversial and like, are they really qualified or not? This guy, from everything I've read, he's expecting a pretty smooth ride and confirmation through the Senate. There's nothing. Yes, there's some, Elizabeth Warren, and there's some progressives that have issues with him. But generally speaking, well respected in the industry. Big supporter of crypto. He actually he's a co-chair of one of these crypto advisor groups, Digital Chambers. He's a co-chair of this crypto advocacy group. So he's an
and he spent the last few years like defending them against the SEC too, right?
Yeah. So, I mean, he's very, very crypto friendly. But what really excites me about him is that he's very, from a overall big picture thing, he's very anti-regulatory, number one, but he's really into opening up and easing the capital formation process. So he's into, and remember, he was a commissioner back in, to your point, 2002 to 2008. So he's got a lot of speeches out there, a lot of positions that we already know of. And one of them, very specific, which is very poignant, and people ask me about this all the time, regarding this accredited investor definition, right? Like this thing's been going on. People have been asking about this forever. He takes the position that we should expand the amount of people who have access to these deals. So he is a proponent of expanding the definition of accredited investor. He's talked about that specifically in the past. And as you guys know, I don't think we've talked about it on the podcast, but that's one of my predictions that I had, that probably if not this year or next year, that's one of the first things that's going to affect us the most. It's going to change the fastest. And that's the updating of the accredited investor definition. I think with this nomination of Paul Atkins.
Mauricio, I think it's worth getting specific on this, because I think it was 2007 where they proposed new rules. And one of those rules included actually raising the threshold to 2.5 million. He didn't really comment on that, other than the fact that he questioned whether the people who are not very rich are like too dumb for making these investments. He flat out questioned that. Like, he did a whole speech on it. And he also questioned why pooled investments were riskier than single stocks or gambling. And he pointed out, in a long paragraph, he actually pointed out that it creates an unfair advantage for rich people. And this is a quote that I love, this quote that he made, where he was like, does this mean that non-rich should be content to just hold their place on the economic ladder? So when you say, okay, like, he's probably going to do this, like, he's flat out said, like, he is a proponent for allowing people who are non-rich to have access to these types of investments.
I will say that proposal that he was addressing was at least looking at it through today's lenses, was pretty ridiculous, because it not only made you an accredited investor that you had to have the $1 million in net worth, the same thing now, but you also had to have $2.5 million of assets investments that you have $2.5 million. So it was not good enough anymore to be a high income doctor making $300,000 a year or $250,000 a year. You actually had $2.5 million of assets that you're basically investing in. So to me, that's one thing that he's absolutely going to be changing. And as a reminder for everyone, the SEC, prior to Gensler coming in, had already passed the rule. Remember that. They already passed a rule. The SEC has a rule on the books that expanded the definition of accredited investor to include the test. And he specifically has addressed the issue of the test. That's where he likes. He likes the idea of having a test in addition to net worth and income. And there's already a rule that allows people to become accredited investor by taking a test by one of these certified financial institutions. The problem is the SEC never got around to identifying and issuing permits for these financial institutions to actually issue the test and do the thing. So to me, that's the easiest, that's the lowest hanging fruit. All the SEC has to do is say, hey, Kaplan, hey, so-and-so, you now have a certification to do the courses, and this is what we want you to cover and do the test. And that doesn't require some gigantic, new rulemaking or a huge process. It's literally just allocate.
Is Trump University still around? I think they're not doing.
That's right. So you could be like, okay, Trump University is going to be giving a certification to be able to give it out. So I think that's one thing that's definitely going to be coming back on the books. And the other thing, which I've also predicted, that now looking into what Paul Atkins has said in the past, again, with this idea of expanding the ability to raise capital, is this finder rule, which I'm also convinced is going to come back before the end of the Trump term, which is going to allow people to basically refer you guys. Like, I'm going to be able to refer you investors and get paid a commission without having to be a broker dealer. That's also something that was a proposed rule right before Trump left office. Kind of just Gensler had no interest in that. I guarantee you Paul Atkins is going to come back in, revamp that up, put that proposed rule back on the books, probably set it out for comments. But I think that's the other thing that's coming in there. So he
loves that too, right? That's another thing about is he loves public comments. Like whenever he did any of his speeches, he always referenced public comments. He threw in some funny ones. A couple of the speeches that I read where he likes to quote people who make funny jokes. So there's a hint. Anybody out there listening, you might get a shout out from Paul Atkins if you leave a funny comment on one of his SEC proposals
or ours. So right here on this podcast, he reads it, he listens to it.
And before I go on to the crypto thing, one thing I do want to point out is that one of the reputations that Gensler has had, which is, I think, well earned, specifically with the crypto industry, but just in general, is that his administration, under the SEC, has really done sort of rulemaking by enforcement, meaning it's very unclear what the rules really are. It's a little bit gray, and you only find out whether you can do something or not once you screw up and you actually get an enforcement action against you. And that's how people have kind of tried to figure out what I can do and what I can't do. Paul Atkins is completely against that. Like, he's a big promoter of having very, very clear rules and then holding people accountable. And when I say people, he's really big into holding individuals accountable, because what happens now is, not in our world, but in the larger context, corporations get nailed for enforcement violations, and there's these huge fines, but individuals don't get tagged at all. It's just all corporations get fines. The shareholders are really left holding the bag. And he really wants to go after the individuals who are, violating these rules. But he's very big on making the rules very, very clear, which I think is one of the reasons why people in the crypto space specifically are super pumped, because right now the crypto's a mess. Nobody knows what's a security, what's not a security. Can I do this? Can I not do that? And I think he's going to come in and just make some very clear.
That was the irony of the whole crypto thing, right? Is that, like, if you look at the crypto world, they actually want more rules. Like, all the heads of all these large crypto websites and conglomerates, they all were asking for more rules because they think it's going to, like, bestow more legitimacy on the asset class. Like, it's going to,
and get rid of bad players that hurt them. The good players get really tired of bad players because it makes them look bad.
But it's the same thing as Wall Street, though. Like, investors like to know. They don't really care which direction it goes. They just want to know, like, what are the rules that we're playing under, whether it's a good thing or a bad thing. Just tell me and we'll figure it out. And right now it's difficult for a crypto company to go spend all this money and invest in some infrastructure and go out into the marketplace and then suddenly realize 3 years after spending all this money that it gets struck down and they have a violation and they're put out of business. So having clarity, I think, is going to really, again, encourage the capital formation, really encourage people to raise capital and go do things and innovate, which he's a big fan of the innovation.
That's the same with the syndication laws. I mean, those are, like, me with my board, everything else, we're all sitting around going, should we divert to different sources of capital? Because we have to hire communications people, we have to hire, IR people, everything else. And so when these rules get fuzzy, it changes. We stop hiring. You stop doing things, because it's like, if they're going to up that accreditation law, did our pool of investors go from 10,000 to 2? If so, can we even raise the capital needed to get through the next 2 years? Or do we need to divert to go from one source to another? And for people that are listening to this, you used to think, oh, we'll just go ask for. It's not that simple, because our systems are predicated on going after one thing.
We get it all the time because we partner with groups, and we just got into it last week where we were like, hey, like, our securities attorney has this opinion of because they sent out an advertisement for something, and we were like, this could be problematic. And we were like, so we went to our securities attorney and we were like, hey, what's your opinion of this? And they were like, no, that you can't do that. That's really, they actually used the word problematic. And so we went back to them and we're like, hey, like, I'm sorry, like, we can't participate in this particular deal. And they were like, we have 2 other securities attorneys that say they can. So we're like, okay,
that's right.
Like,
that's exactly right. Like, even like basic stuff, even, like, just not to get off on a complete tangent. I can talk about this for years, but like, even basic stuff, like, advertising. Like, you'd think, because it's such a central piece of the regulations, that there'd be some definition, some clear definition of what constitutes advertising or what constitutes general solicitation, what doesn't. And the reality is, because especially with technology and the internet and all this different way, now we have AI. Like, now the question becomes, like, AI bots. Is that enough? Can you have the AI bots communicate with investors, and does that count? Can you establish relationships with your investors using AI? Like, all of this, it's not necessarily a fault of the regulators. It's just that the technology is also evolving to a point where it's just new stuff happens every year. Like, the AI is the next frontier. Like, even if they fix all the stuff about the internet and technology now, Now we have AI to deal with it. Somebody's
and I'm hoping if they do this test and they make it like not easy enough, you don't want it to be easy that anyone could do it, but like accessible enough that anyone can do it, that this whole 506B issue, like it just like 506B, I know is already a small portion of the Reg Ds, but like whenever we have issues, it's always with someone who's trying to do a 506B. That's why we have like a rule. We don't do 506Bs anymore, but like, it's always someone like trying to say, okay, what is a substantial relationship? What is advertising? What is all these different things? And that's where like all these gray areas came out. And I'm hoping like if what Mauricio says is true, where they're just going to switch right to these tests, that like people won't need to do 506Bs, right? Like they'll just say, hey, if you want to come invest with us, here you go, take this test. And you know, we don't have to do this 7-step program or whatever the
and there's still a lot of confusion. Like I'll get the same, like I'll get a like even yesterday somebody asked me about like, hey, you know, now that the accredited investor pool is going to shrink, we're thinking about doing this, the other, and then other people's like, well, they're going to expand the definition. There's going to be more. So there's still, even today, there's like, is it going to get expanded? Is it going to be shrunk? Like, what the hell's going on? And so having some clarity on that, I think. The Paul Atkins is going to bring some clarity.
Well, and the AI portion you mentioned, Mauricio, I got to say, I think this is way bigger deal than people think it is. The lawmakers are so slow to this stuff where they're still trying to understand, right? Is Facebook a social media what, you know, how do I log into my Facebook? And then you have AI who is becoming completely centralized in all our businesses. And how that interacts and is front facing. It's the same thing as these states, like one I'm in, took how long till it was 2018 to say the email was certified. What that does to businesses, it you know, hopefully the Trump's administration said they want to clear the way for AI. They want to open it up, but the laws have to be able to follow it or it creates log jams. And the interfacing with individuals through AI, I think, Mauricio, you should do a whole entire literal segment on this because I think it's a big deal.
Well, we just used the example, right? Crypto. Like when you don't have proper rules and regulations around it, it becomes a shit show. It becomes people just like the SEC trying to fit it into current regulations and suing. And then like, I think the biggest thing with Gensler is he had like 47 of these things he tried to get passed. And the majority of them just went to court and you're either still in court or just got shut down. Like he got very few rules actually passed through. And all of these things that are currently in court are probably just going to get reversed by the guy coming in. And so like he had all these ideas, but well, and one of the big arguments too, and actually Paul commented on this when the whole ESG thing, which by the way, they had the ESG initiative for the Gensler had that as like one of his things. That's gone. Like any ESG proposals that he had going there, it's because Paul commented on the last time, and he said that it oversteps the commission's congressionally delegated regulatory authority. So that's a mouthful of words there. But basically, like a lot of the things that Gensler tried to get passed, everyone was saying he's overreaching, he's overstepping. And so actually that's a question I was going to have for Mauricio is like, are they going to narrow the scope of the SEC now? Because it seems like that was a big issue last time with Gensler was like, he was kind of taking liberties with what they were allowed to do. And now it seems that Atkins is bigger on creating rules and creating more transparency. Like, is he going to narrow this for us? So
he's 100% going to do that. Yeah. I mean, even like, and there's other agencies too. I mean, and a lot of it has to do with, you know, how people are being sort of tried and sort of bypassing the court system. And like the IRS is a good example. You have the IRS, you've got a tax issue. There's like IRS courts and same thing with the SEC. You've got these SEC things going on. So I 100% expect, and I love how you're on a first name basis with the guy already, Paul. But future Commissioner Atkins.
I was thinking the same thing.
I tried his diet and everything. It was great.
But yeah, I just wanted to go back on a quick point about the AI thing. But like, you guys remember, you know, all those old senators talking to all the social media platforms, and the questions they asked, just they had no clue about social. And this is from 20 years ago. So remember, most of the securities laws, in fact, I would say 99% of securities law emanate from the rules that were passed in 1933. It's almost 100 years. These are 100-year-old statutes. Like,
that was before Facebook.
So anyway, I'm pretty pumped, not just because it obviously affects what I do, but just for from the perspective of you guys, like syndicators, issuers.
Let me
like
ask you a
clients.
question, Mauricio. Timing. Like, can we expect things to move quickly? Is this going to be first year stuff or is this going to be third year stuff?
The accredited investor thing, I think that's already on. I know you can go in step by step, but like the accredited investor thing, that's already on the book. So theoretically, they could literally on day one, if he really wanted to make, I don't think it's a high priority for him, but literally on day one, he could come up and say, "Hey, I'm signing this document that officially designates all this stuff, and accredited investor is officially there because it's already passed. Everything else has to go through a process, right? So, and I think even the final rules, they may release them again because again, he loves the public comments, as you mentioned, Kyle. So it is possible that even if they've got the proposed rule that was passed or a rule that was,
he's
final,
got to put out a lot of fires too. As I said, there's a bunch of stuff tied up in court right now.
What'll probably happen is that his staff will, because remember these rules are like 600 pages long, so his staff will probably go through it again, tweak some of the language, and then release it again for comments to the public. And the way that usually works is like literally, it probably takes almost a year from the time they come out with a proposed rule to a final rule because there's a comment period, there's a rewriting, So most of these are going to probably be the second half, I think. But some of these, like the accredited investor definition and the ones that have already been sort of proposed, I think those will be much quicker.
Is that wish casting on our part?
No, I will go on. I predicted this. I'm going on record that the accredited investor thing is going to happen. If it's not 2025, which I think it is, it's definitely the first half.
Awesome. That's good news. Anything else? Any other comments about Paul, or is it all good stuff? Because it sounds like to me he's pretty awesome.
Yeah, the other interesting thing that just gives him a little bit more power is that remember, there's 5 commissioners on the SEC commission, 3 from one party, 2 from the other. The other 2 that are from his party used to clerk for him. So they're his clerks. So if you can only imagine that, whatever his agenda is going to be, we would expect that the other 2 they're not going to give him too much roadblocks in terms of whatever it is that he wants to propose on the agenda. My guess is it's going to go forward.
Awesome. I kind of went down the rabbit hole a few times on some of his testimonies and his speeches and stuff. And on the one from 2016, his one testimony to Congress, he mentioned that we need broader blue sky exemptions for Reg D offerings. Was he just mentioning? Was that just for like accredited investors, or do you think there was I
didn't see that specifically, but just in general, very few people use the state exemptions because they're just super difficult. Like it's much easier, even if you're, let's say you're in Florida. Florida's got a relatively easy exemption, but it's still, from the attorneys I've talked to in Florida, they still would rather do a 506B than do whatever the Florida exemption thing is. It's hard. So I'm guessing what he's saying is he wants to liberate that and let states make it easier for people to rely on the state exemptions versus having to rely. Because a lot of the states, for example, your state, Pennsylvania is a good example. They have like a self-executing exemption. So if all of your stuff's happening within Pennsylvania, it's really easy to get the exemption. And it's like you spend like a couple grand and you're done. There's no PPM. It just check the box and it's really easy. And I think that's probably what he's referring to. If we can expand that ease.
So that was my question. Is that going to affect us? Because, the moment I see blue sky and Reg D, I'm like, ooh, we play in that space.
It'll affect, I don't know. In our space, most syndicators have investors from so many different states that the idea of having to go comply with 8 different states because you have investors from 8 different states, I think that's still, it's a long shot. I think it's for smaller raises. If literally you want to raise money from 5 of your buddies or 10 of your buddies and they all happen to be in your state or maybe 2 states, then maybe. But for the traditional raise, like what you guys are doing and you're just, you're getting from all over the country, you're going to end up with 6, 7, 8, 10 states. It's probably not worth trying to go that route.
Here's the nice thing about Paul, to use his first name. Unlike all the billionaires that Trump has nominated or appointed, this guy is only worth about $60 million. So he's a common man like us.
That's How much
that's kind of a downside to him.
You holding out on me, Jay? All right, cool. So it sounds like awesome. Like best news ever. We're all excited, especially Mauricio. You can see he's a little giddy.
Anything I can help my clients. Let's do it.
Awesome. Should we move on to a top 10?
Top 10.
Wait, I thought we had a new resolution that for 2025 there was no top 10. We were going to switch it up.
Your resolution?
Is that not happening?
No, so just like most resolutions, they're done by the first Friday. That one was gone. So it's we're going right back to the top 10. I couldn't kick it. I'm addicted to it, and No 40 days or anything. Just right back to it. Speaking of vices, most of the South started their own version of Dry January this month. I don't know if you guys heard about this, but beginning last Wednesday, Florida, Jay, Tennessee, South Carolina joined the growing list of 14 other states where residents can no longer access popular pornographic websites due to age verification laws. So they're banning porn in all these states.
So they're banning porn based upon age, right?
Well, it's the verification laws. It's basically too hard to verify. Like, it would be too hard to verify somebody trying to access it for these sites to actually be able to make it profitable and make money. So
Jay, how does it work? You log in and give us how does it work? You log in, you do what? How does it work?
What do you do?
How do you get verified, Jay?
All I know is my wife has been asking me repeatedly, why have you been so nice to me since New Year's?
So I thought, in the spirit of this, I wanted to see what the top 10 most porn viewing states in the country are. And to my surprise, Idaho did not make the list.
What?
They are not in the top 10. I really thought they would be up there because I thought it would be a funny comment about Idaho, and everybody just there's nothing to do in Idaho.
Is it Idahonians? Is that correct? Is it Idahonians? How do you say it? That's a good word. I like the one. Idahonians. I was going to say Idahonians.
It's Idahoans.
Idahoans like to load their own dishwashers. Apparently,
Fun fact: according to Pornhub, the most common search term of people in Idaho using the site is lesbian.
Oh, that's a nice one. There's much worse ones out there. So good on you, Idaho.
Really?
You know who did make the top 10? California, number 10, sneaking in there. So I didn't want to skew it by sheer size of states. So I found a top 10 that was page views per capita. So California has 144 page views per capita. Number 9, Georgia. I knew Jay spent a lot of time there. Number 8, Virginia. Number 7, New York. Number 6, Hawaii. I didn't think that would be on the list, but apparently out there in Hawaii, you still get it done. Number 5, Mass. I never say the full word because my wife makes fun of me how I pronounce it. Number 4, Colorado. Number 3, Illinois. Number 2, Nevada. And number 1, I think Nevada's probably for professional reasons. Number 1 is Kansas. And not only is Kansas number 1, this is like a steady 144, 145, 148, all the way up to 166. And then for Kansas, it jumps all the way up to 194. So 15% above the next highest. So there you go.
What is it? What's the per capita in Canada?
Ooh, I'll have to look that up. We're pretty nice up there. I feel like people would be too bashful to do that.
You got a lot of cold winter nights.
That's true, but we huddle up with each other. We don't need the internet. There's not, the internet hasn't even reached half the country, Jay.
Okay, well, I did notice Florida wasn't on the list, so apparently I wasn't doing my part.
It's all the old people there. They can't even pull it off. Literally.
They don't know how to log in.
See the pun there? The pull it off? Sorry. Okay. Hypothetical situations. I have a list here that Jay has made a list of hypothetical situations he wants me to say. So
they were just options if you were looking for a fun game to play.
Okay, well, I have to skew the numbers here a little bit because we have AJ and the whole $10,000. I don't think that's going to do it.
Yeah, I looked at that list and I was like, not even close.
Yeah, exactly. Add a 0 to some of these.
Wait, there's a list
for AJ.
There's a list somewhere.
Well, I mean, that one, if you're going to do it once, you might as well do it 1,000 times.
Well, what about the one that's if there's a button in front of you? So if there's a button in front of you, and each time you press it, you get $100,000, but a random person on the planet dies. But it's guaranteed it's not somebody you know. It's just you just know somewhere out there just died because you pressed the button.
8 billion people. One person dies.
Do you press the button? And how many times do you press the button?
Wow.
I feel like if you're going to press it once, you might as well press it 1,000 times.
Right. I feel like it's the first press is the one, whether you do it or not.
And then after that, you have no conscience anymore. So it's just
Yeah, exactly.
I mean, if I was guaranteed that they were going to be Idahonians, then maybe.
Can you pick their political affiliation?
Okay, who here presses the button at least once?
I don't think so. There's no. I mean, yeah, it's not now.
At this stage in my life, no. I'm sure there were stages in my life that I probably would have said yes. Jay, are you pressing it or what?
I'm not pressing the button.
100,000. So is there a number though? $1 million.
Well, no, because here's the thing. If I'm going to press it at 100,000, if I can press it once, I have no problem pressing it 1,000 times because 1,000 random people out of 8 billion. I mean, unlikely any of them are even.
There's a number though, Jay. Like you would press it for $1 billion. I would press it for $1 billion.
But I wouldn't because I could press 1,000 times 100,000 and that's $1 billion.
Do you find out who the person was that you killed, or you just know it's like
you're forced to attend their funeral?
No, that makes it better for me because if it's like $1 billion, then I press it and then I just make sure their family's taken care of the rest of their
forever.
life.
Yo, sorry I killed your dad, but here's $1 million.
Yeah,
I got you.
So no one's pressing it. All right. Well, that was. Should I save these other ones or should I go through them?
Go one more.
One more. Okay. You get $50 million tax free, but you can never earn another penny. Do you take it?
Can I invest it?
Nope.
No, you can't earn another penny.
You can't earn another penny.
You can only spend it.
It's a drawdown account.
Man, that's a tough one.
What about you? What about your kids? Can they spend it when you die, or can they invest when they die?
Nope. But they get the leftover. They can't invest it, but they can get.
So I can't create a company that doesn't make any money, but until my kids fix it.
Nope.
Oh, then no, I'm not taking it.
Man, that's like $1.5 million, $2 million a year. How much longer am I going to live? I'm also 52, so I don't know, 40 years.
Ooh. Side note though, but like, can family members of mine make money, or is it like, can my kids make money? My kids can't make any money.
Nope. It's a drawdown account.
But my kids can't make money.
That money is uninvestable for anybody.
No, but like my kids could go off and like get other jobs and create other businesses.
Absolutely,
and stuff, right?
100%.
All right, then I'm taking it.
You're going to invest in your kids. They can't make money with that money, though.
I know. I'm just going to help them create businesses that are, I'm going to take all of my resources, know-how, knowledge, all that stuff, and funnel it through my kids.
Okay, let's do one more because this one I think is interesting. $2 million per year, but you hit every red light.
Even if you're a passenger?
Even if you're a passenger, as soon as it turns red.
$2 million isn't enough.
$2 million is not enough.
But
no.
I would just get a driver.
No, that's what he said. Even if you're a passenger, you have every light. But you know, there's no red lights in the sky though, right, AJ?
There you go.
Yeah,
helicopter baby.
So you need more than $2 million
a year. Spend half of that on a helicopter every year. Done.
You're not taking a helicopter to go out to dinner. Most restaurants don't have a helipad.
True.
Yeah, $2 million's not enough.
It's gonna suck the first time. Like you.
At first, I'm like, yeah.
A ruptured appendix, and the ambulance comes, and it's like,
so
every red light.
I know there are places that have because I know in Canada it's becoming a big thing, roundabouts. So like if you go to Europe, there are like in the cities, I lived in where is it in Germany? Berlin. I lived in Berlin, and there's no stoplights anywhere. It's all roundabouts. So I feel like I could just find a place there's no red lights.
I don't think it's a huge deal. Although I live in SoCal, so most of my travel is freeway. So it's a little bit of red lights before the freeway. Like I have one light before I get on the freeway from my house, and then wherever I get off, there might be a
That's
few.
my point. I feel like you could find a place where it's manageable.
Yeah. I felt like $2 million was a good number. For that number, it makes it tough for me.
It makes it tough for me. It'd have to
Is
be
it tax free?
Yeah, call it tax free.
Yeah, I'm in. I'm doing that one.
I mean, if you're making $2 million a year, like you got a lot of time on your hands to figure out a way to get around it.
Well, that's my point. Like I would have one of those sprinters, right? Remodel the Sprinter to look like a private plane inside and have a driver. And yeah, I have to stop, but I'm like doing other stuff in my Sprinter in my freaking luxury office. That's a mobile office.
Is there a max number of red light violations you can get? Because what is it, $100?
That's now there's a good point.
Just run every red light.
And most red lights don't have cameras, but
right. Well, you make sure you live somewhere where there's no red light cameras, and you just gotta even if you get caught every time you go out, like that's only $100.
Okay, I'm gonna do one more. Do the bottom one. I like the bottom one.
What's the bottom one here? You get $20 million, but for the rest of your life, every dog you meet under 10 pounds will be hell-bent on killing you?
Absolutely, I'm doing it.
Because it gives you the opportunity to kick many dogs,
exactly. I would get a whole bunch of attorneys. I'd get all this liability protection, everything else like that. And I would kick every one of those little dogs. They run up to me, and I just boot them. I hate little dogs.
Except for the ones that look like they're owned by rich people, then you just let them bite you, and then you sue them.
Exactly. Either way, I don't care. I'm either going to kick you or smash it.
Yeah, I wrote this one with dog lovers in mind. I guess I didn't take AJ into account.
You should say over 10 pounds. Then I'm not doing it. Yeah,
over 10 pounds is easy. Yeah, you're not going to do that because those can actually hurt you.
Yeah.
Yeah, I would kill a man for my dog, but he's 75 pounds.
Yeah, that's a mine is 140 pounds. Yeah. And he's the cutest, sweetest little thing ever.
Second, probably, but all right. Plugs. Mauricio, you got anything?
Yeah, I got my, I'm launching, I've already pre-launched the coaching program. So if you're a syndicator out there looking for some coaching, I got about 35, 40 people in now, but I'm fully launching at the end of the month. So if you're interested in coaching by me, go to Instagram, follow me there, and just DM me the word coach, and we'll see if it's a fit.
Awesome. Yeah, we obviously a big fan of Mauricio and his teachings, so go check him out. Jay, how's it going?
Good. So I'm going to start with a little plug for the show. Next week, one of the four of us is not going to be here, and we have a guest host fill-in who is going to be absolutely amazing. I'm not going to say any more.
Tell me it's Mauricio who's missing.
I'm not going to say. I'll let you guys, if somebody wants to out yourself, feel free. But otherwise, tune in next week and find out who's missing and who the guest host is, and you will not be disappointed, I promise. And then in terms of the plug, let's see. I'm going to go with DRE Daily, our daily economics newsletter. We are over 2,300 subscribers. We more than doubled our subscriber list over the holidays. So, you need to be checking out dredaily.com.
I read it every day. AJ, what do you got for us?
So I have rolled out new YouTube series. They're in-depth. We're doing a couple in-depth 1 months that are explaining more complex topics. And so we use data, and we're putting a lot of stuff out. The first one came out, I think it was yesterday or today, which was millennials versus baby boomers. And it was understanding the economic situation they're both in and how millennials got to the point where they are. And so trying to take more of these cultural things that people see or understand that are confusing and really drill it down to this is what's happening. And we use lots of, I think, cool data, a lot of imagery to show and explain its narrative format. So go to AJ Osborne on YouTube and subscribe, and you're going to get them. And then we do shorter ones every single week that are explanations, like things like how does a company really yield from stocks and different things like that. And
well, now I'm excited. I didn't know about this. You need to tell us about these things. I'm excited to check this out.
Yeah, a new format too of how we're videoing it. And Alex did this one time we released it. The thing that I don't like about it is my cadence, like how I'm talking. I'm like, I needed to make that a little more natural. But how she did it was awesome. It looked really good. She did a great job. Go check it out.
Sounds like a good producer. We should ask her if she wants to have any involvement in this show.
Hey, fun fact, since you were mentioning millennials and Gen Z, as of January 1st, every new baby that is born is
betas.
Generation Beta. We've got a new generation as of January 1st.
How much is that a troll? Like, it was just like, we're going to create all.
I am so glad I'm done having kids. I have no betas.
It was just some old grumpy old, baby boomers. Like all these young kids these days, they're all betas. Might as well call the new generation betas.
They didn't know what it was. They're like, we're going to call them betas. This is some good thing because they have no idea.
Let's be fair. The last generation were alpha, so you had to kind of follow the trend.
I, as my kids call me, I'm the Alpha Rizzler. So there we go.
Nice.
You've got mad riz.
Compliment right there.
So, should I switch this up? Should I plug my wife, Badass Investor, or should I go load the dishwasher? Or is that the same thing? Badass Investor on Instagram, Badass Investor on YouTube. Go check her out. Her subscribers keep following and keep growing. So she must be doing something right. So go check her out. She's much better looking than Jay and has better content. So.
Send her some love because I saw a post when she got up at like 2:00 in the morning the other day. So she must be really.
Oh yeah, she pulled an all-nighter the other day. It's I go to bed, wake up, she's still not there. I walk down and she's still working. So it's yeah, she works much harder than Jay as well. So go check her out just for that reason.
doubt.
That's all I got, guys. Good episode.
I will see 2 of you next week.
That's right. Yeah, someone's bailing on us or doing first one episode.
Check this out. Somebody's going to be at a black tie event at a ranch in Maui.
Yeah, and couldn't set aside an hour and a half just to be with us, but that's fine. I tried to do the podcast with pneumonia and right up until the last moment, but that's fine. You go to your black tie event. We'll be fine. We got a good guest coming on anyway.
I didn't say it was me. I said one of us is going to a black tie event.
I'm not saying that Elon Musk is going to be the guest host next week, but it could be.
But it could be.
It could be.
Or
No, it
Trump.
can't. We already
Or
picked the
Trump.
guest.
Or Trump.
But yeah, all right. So I got to go load the dishwasher. So for 2 of you, I will see you next Tuesday.
Later.
See you guys.